Welcome to the LifeGuide tutorial. This tutorial is produced today, June the 2nd, Tuesday, 2015. This tutorial will deal with the rate of return, internal rate of return, accounting rate of return. Various titles are used for that. Functions within LifeGuide. The internal rate of return, or the IRR of an investment, is the discount rate at which the net present value of costs of the investment or investments equals the net present value of the benefits of the investment. Therefore, in simple terms, the IRR, or the internal rate of return, is the effective interest rate that would have to be earned on the single or determined periodic investment principal amounts so as to, over a given period or periods of time, achieve the accumulated future value amount. The return on investment financial functions in LifeGuide, MultiCalc, reflects the accounting internal rate of return, also known as the average rate of return, or the ARR. ARR calculates the return generated from net proceeds of a single or series of capital investments. It is expressed as a percentage. Thus, if the ARR, for example, is 7%, then it means that the investment is returning or is earning 7 cents on each dollar invested on a yearly basis and compounded annually. When comparing investments, the higher the ARR, or the higher the rate of return, or the higher the internal rate of return, the more attractive is the investment. LifeGuide includes an easy-to-use return on investment calculator amongst the various financial calculators in the MultiCalc module, which we'll touch on later on in this tutorial. LifeGuide also includes two internal rate of return functions within its comparative evaluations for life insurance. These are internal rate of return for coverage, in other words, for death benefit, and internal rate of return for CSV. By the way, internal rate of return for both coverage and CSV can be viewed on LifeGuide virtually instantly for any policy year. This is so because LifeGuide includes detailed values for each and every policy year, not just for every 5th or every 10th year or whatever, but for each and every policy year. So let's proceed then and review these with an example case. I'm going to use the case in front of you here on the screen, which is a 35-year-old male who has not smoked or consumed any tobacco or related similar substances for the recent 5 years, who is in average health and who is considering a 20-pay fully guaranteed for both premiums and for coverage whole life policy contract for $500,000. So we've got a 35-year-old male non-smoker regular going for a whole life guaranteed 20-pay product for a face amount of $500,000. At this point, I'd like to note that the figures being shown are correct and accurate on the date of creation of this video. However, it should be viewed as for illustration purposes only, since product availability, rates, and values are revised quite frequently by the insurance companies. It's quite possible that within a week or two after I produce this tutorial, the rates will have changed. So again, this is for illustration purposes only. All the figures shown and all values shown are totally accurate and exact as of this date, but will be changing over time. So let's proceed and run the survey of quotations for this gentleman. So we'll click on quote, single life, single insured, and we have our survey in front of us. Now, the figure 0 that appears here next to the premium payment mode reflects that what we're doing here is looking at things at inception. In other words, the initial survey that we have is done at inception. So in order to look at how this picture looks like in 20 years down the road, we will change this 0 to 20 so that we are looking at the end of the 20th year past inception. We see that the product appearing at the top at this point is annotated with exclamation marks. These indicate that there are important notations to be considered, along with, and in all cases, with the plan description as well as the policy wordings. So in order not to diverge from the topic of this tutorial, I'll click on the second product that appears in this survey. This product is offered by Desjardins Financial. Then to examine the comparative scene at the end of the 20th year with the accurate internal rate of return figure for coverage, I'll click on the drop-down menu and select internal rate of return cover. So let's do that. Okay, I go for the menu and I scroll down here to internal rate of return cover and I'll click on that. The results are instant, as you can see, and the products are reordered in descending values for the internal rate of return for coverage. We see that the 20-pay whole life product offered by Desjardins dropped from second position to 8th position. It was up here before, it's now down at the 8th position relative to the other offerings for internal rate of return for coverage. Okay, but stay tuned, please. As can be seen, the figures for the internal rate of return are quite attractive, even at this position. In this example, in the double digits for all of them. This is further accentuated when we also take into consideration that in most, but not necessarily all, but in most cases, the proceeds of life insurance are tax exempt when payable to a person or persons who are designated as beneficiaries. In this example case, we see that the premiums payable during the initial 20 years are $5,585 annually. Okay, we've chosen annually. And are payable only during the first 20 policy years. The notation here, PPP, and then 20, means that the premium payment period is 20 years. So again, the PPP is an indication of the length of the premium paying period. The guaranteed coverage or death benefit is $500,000. That's the face amount. The 12.82901% figure for the internal rate of return relating to coverage or to the death benefit for this Desjardins product for this specific example means that we would have had to achieve a guaranteed annually compounding net of tax and net of administrative charges return of 12.82901% on 20 annual deposits of $5,585 in order to arrive at the value of $500,000 at the end of the 20th year. So if this person died exactly at the end of the 20th year, and he will have paid $5,585 in premium each and every year, That would mean that his return on each of these premium investments would have to be 12.82901% in order to achieve that death benefit. The internal rate of return for the CSV relative to the premiums paid is also instantly available on LifeGuide. I'll click on the menu up here and I'll select internal rate of return for CSV. Interestingly, we can see now that the Desjardins product, which was in number 8 position for internal rate of return for coverage or for death benefit, is now appearing at the first position for CSV. And as can be seen, the same Desjardins 20 pay whole life product is zoomed up and is showing an internal rate of return for CSV of 1.09656%. If we want to investigate this a bit further, double-clicking on the product, let's double-click here, brings up the coverage costs and values analysis spreadsheet. Scrolling down to the 20th year, let's scroll down here to the 20th year. There we are on the 20th year. We see that the CSV at the end of the 20th year is $125,500. These are the annual premiums. By the way, if we scroll further down, you'll see that the annual premiums cease. The CSV continues to rise. Just to show you one more thing very quickly, this chart can also be viewed graphically. So if I click here on this icon, I have my graph. If I want to look at everything, you see how the cash surrender value, let's just clean up to make this a bit more easily seen. Okay. We see that the cash value rises fairly rapidly to the end of the 20th year and then continues to rise. This line here, this bluish line here that we're looking at, is the interest adjusted accumulation. In other words, had we invested this $5,585 each year for 20 years and then continued to leave it invested at a gross yield pre-tax of 5%, we were taxed at 45% on the interest, we would end up with a net yield of 2.75. So at 2.75 net of tax, this would be our value line for the investment. We can see that the cash value, in fact, nicely exceeds the alternative investment. But let's return. I'll close this. By the way, you can click at any point. Let's click here since it's an interesting one. Okay, this is the end of the 50th year, at which point we have a cash value of $436,900, but our opportunity cost was only $339,000. So it gets interesting. The risk amount is fairly small. Most of it at this point is cash value. This individual is 85 years old at this point. Well, anyways, I'll close this. I'll close the graph and I'll close the CCVA to return to the earlier screen. The 1.09656% figure for the rate of return for CSV measured at the end of the 20th year means that we would have had to achieve a guaranteed net of administrative charges and net of tax return of that 1.09656% compounded annually on annual deposits of 5,585, which are the premiums in this case, in order to accumulate the guaranteed sum of $125,000, which is the guaranteed cash surrender value that we saw in the CSV, in the CCVA, in the coverage cost values analysis right here. Okay. Now, let's double check this using LifeGuide's return on investment calculator, which is included in LifeGuide's MultiCalc financial calculators module. To invoke the MultiCalc, I'll return to the main screen of LifeGuide. So what I'm going to do is I'm going to zoom this down and go to the green money bag icon. Now at the menu, I'll select the first option on the menu, MultiCalc. And I'll bring up a fresh one, and I'll click on the Return on Investment tab, which is over at the right. Now let's enter the figure of 5,585. We'll go periodic deposits because we're paying the premiums annually for 20 years. So let's enter the figure of 5,585 for the periodic deposits. 5,585. And I'm going to leave the premiums, the premium payment mode annually, because the premiums payments were calculated annually to start with. We will assume that there will be no withdrawals. In other words, there won't be any policy loans or charges against the policy value. So I'll put just a 0 in here for withdrawals. And as we saw earlier, at the end of the 20th year, the cash surrender value would be $125,500. So that we'll put that figure in for the residual capital, 125,500. And that will happen 20 years from now. So we'll put 20 in here. I'm going to leave the figures for the anticipated inflation and taxation at 0, as discussion on these two fields would go beyond the scope of this tutorial. So let's just leave it at 0 here and at 0 here. Okay, since I've put the tax rate at 0, it doesn't matter whether we're looking at gross pre-tax or net of tax. So it will be the same thing. And of course, we're taking the money out at the end of the period of 20 years, not at the beginning of it. So we'll put in arrears. As soon as I clicked here, I have my 1.097%, which is our earlier figure from the LifeGuide survey, which was 1.09656, but rounded to the third decimal place. In LifeGuide itself, we go down to the fifth decimal place, whereas in this quick calculator, we go down only to the third decimal place. So that's it, folks. And before closing, I'd like to note again that the products and figures shown in LifeGuide surveys that were just done are accurate and current as of the second day of June 2015, when this video tutorial is being created. Excuse me. Products and pricing change rapidly, and of course, each case deserves to be examined for its own merits and within the context of the client's needs and circumstances. So please keep that in mind. The idea here was to show you how it's done. The figures will change over time, of course, but the principles remain the same. That's all, folks. Thank you for watching, and please don't hesitate to call and ask if you have any questions. Thanks again.